Okay, this will be part 4. Actually, this is the last part in this series on the income statement for the multi-project cooperative. So, okay, a little review of parts 1, 2, and 3. We went through the basic income statement, which has the projects, has them divided out, separated, and consolidated on the right. We did the other income. We had the before tax profit net income. And then we did the allocation for members. And then we did the allocation for surplus reserves. And then we did the little details of how each member of the projects received their money. It was on a point system. These 34 points are actually 34 points of 82 points. So the project manager has 82 points to distribute amongst the project members. So, and that's all figured out on that other sheet. If you remember on this other sheet, where the project points here, these project points are really calculated from hours times job level times the scale job level, point hours, and then they get project points. So there's project hours, which basically weights the involvement, the participation of each member, and then that becomes a percentage of 90. All right, so that's a quick review. Oh, I also did the member accounts of how much is retained for each member, how much is paid each member, their interest, and how much they actually ended up making per hour of work, and the retains. All right, so all of this information is now automatically calculated into the general ledger to close out the books at the end of each month. So all these journal entries that you're about to see are automatically created from parts 1, 2, and 3. So first of all, you have co-op administration is posting these operating expenses, like advertising and bank credit card fees, insurance, taxes and license, miscellaneous, and office supplies. Now these operating expenses are going to be transferred over to the projects. So here, these are actually the general ledger of the consolidated projects. So here this 200 moves over onto their books from a credit to a debit. And if we move over here, we'll see actually how the advertising is debited to the food truck and to the t-shirts. There's your $200 for the consolidation. So you'll actually see the general ledger for each project is automatically calculated too. As you come down, you'll see all these. These are all the general ledgers for each project. These are all automatically calculated. And all you have to do is just print them out, post them to the general ledger, you're done for the month. So instead of just going through the specific general ledgers for each project, I'm just going to compare the general ledger for the co-op administration to the consolidated projects. And you just have to know that the consolidated projects is broken up into each project being consolidated into this right side of the sheet here. So here, operating expenses from the co-op administration are being transferred to the projects to put them on their income statements. And then as we come down, we'll see that now the co-op expenses are being paid for out of the project's checking accounts. So these are all going to be accounts in the chart of accounts in the bookkeeping system for the multi-project cooperative. So you see that this $1,453 is now being credited to the the checking accounts of the projects, so the money's being taken out, and then it's being transferred over to the co-op administration. So now the projects are paying for these expenses, and the co-op will now is getting reimbursed basically for having to pay those expenses in the first place. Okay, so all these are automatic. This all balances the books between the co-op administration and the projects. So this makes sure that the co-op administration, that their income balance zeroes out, and that all the expenses end up on the income statement of the particular projects. And here we come down to the interest allocation. This is how much interest is the members receive on their member equity accounts. So these are just the number of the account, the name of the account. So instead of it getting very detailed in what each of these account names are, I think I'll just rather show you that this is the general ledger. This is the entry in the general ledger for the interest allocation. And then this becomes the entry in the general ledger for the co-op net interest. And if you look, this $21 comes directly from C66. And that's actually over here. That money right there, that $21. That's just automatically comes over here. Now, these are the project loans net interest. So this is basically saying there were no loans. Now here's the important one, the income summary. The income summary is a very important journal entry. And the income summary takes the net income and then divvies it out, remember, into that 90% that goes to the members and into that 10% that goes to the surplus reserves. There's no startup losses this month, so. And then if the co-op administration has its own income summary, it has its own accounts for doing that over here in its own books. None this month. No income, no income summary, no startup expenses, so these are all empty. But this journal entry right here of income summary basically closes the books for the projects at the end of the month. And no more startup losses, so nothing to see there. Now we're allocating the dividends. So we have $13,218 is being allocated to the members. This is the portion being paid. This is the portion, 4,402, that is being retained. Now what actually ends up happening is this retain stays with the projects. So the members, the retains of the members stays within the project. So the projects have authority to use the retains of their members in their projects. Now I wonder if I should repeat that. All the members that work in a project, let's come over here. This is the food truck, remember. This is the food truck. $3,914 are the retains of the members who worked in the food truck. This money will stay in the checking account of the food truck. So the members, and even though the members worked in various projects, their work in the food truck has income. And during that income there is retained portion, and that retained portion stays with the food truck. Now if a member worked in the t-shirts, the retained portion of their income from the t-shirt project stays within the t-shirt project. So those projects have access to the retained portion of the members who worked in the projects. That's very important. And then the surplus reserves are divvied out to this project growth that will stay in the project, in the checking account of the project that it comes from. And the general surplus, general co-op surplus, this goes to the general co-op administration, and these are your estimated taxes. Okay, now these are just transferring the estimated taxes from the accounts to the co-op administration so they can be paid out of the co-op administration checking account. So the monies from those taxes are transferred over to the co-op administration. You see that debit in the co-op administration checking account? That means the money sits there waiting to be paid at the end of the year when taxes are paid, corporate taxes are paid. And all these journal entries are automatic. And now this is transferring the net income balances. So now you're moving the money. Whatever is going to go over to the co-op administration now moves with money. So money is taken out of the checking account to equal the interest, the patronage dividends. The member retains, but you'll see the member retains the money. The money stays in the projects, but the actual recording of the member retains will go into the co-op administration books over here. This one right here says the member retained funds to receive. So the member retained funds will need to be received later. But right now it's just the member retains are going to be recorded in the co-op administration books. So to keep track of who has what kind of retains, but the monies are actually still kept within the projects. That's a tricky point and very important point. Okay, so the money moves over. You see the debit to the co-op administration checking. Boom, 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 boom. Now you start allocating it out. So these patronage dividends, they're allocated out. So much to Jackie, so much to Daniel, so much to Carol, so much to Tim. This is the non-retained portion. This is what they're going to actually be paid. And now you come down and see this is what their retains are. They're not actually being paid. These are just going into their accounts, being recorded into their accounts, into their co-op administration accounts. That Jackie now has $1,662 of retains for this month, and each one has their own. And now you come down and see this is how much is going to be allocated to their member capital accounts for interest. And now you come down and say this is how much is being allocated into the surplus reserve accounts. And this is where you actually pay out the money. So you credit the co-op administration checking, so you're taking the money out of checking and you pay Jackie, Daniel, Carol, and Tim. And then they report this income at the end of the year on their personal income taxes and pay taxes. So all of these journal entries are automatic. There's no figuring in them. They just automatically calculate from the income statement on the previous part. So that basically completes the 4 parts on the income statement for the multi-project cooperative. Thank you, and I'll prepare another series on another subject. All right.